Good morning and welcome. On behalf of Keiter, whether virtual or in person, I want to thank you for joining us today. We're here to present some not-for-profit insights, and it's really nice this year because the FASB and the IRS was kind to the industry in many ways and didn't come out with too much news. So it gave us the opportunity to really, bring to the table what we thought may be most, relevant and important to our not-for-profit clients. So with that, we'll take a look at today's agenda. You'll see that we're going to start out with gifts in kind presented by Courtney Corallo, revenue recognition, what have we learned, presented by Preston Jones. Then we're going to have a 10-minute intermission, kind of scheduled from 9:50 till 10. Then we'll come back and look at functional expense reporting for nonprofits and split interest agreements, which I will cover. And then we'll do kind of switch and talk a little bit about tax. And the subject there is why we ask common questions when preparing for 990 and 990 PFs. And that's going to be presented by Ginny, Belcher, and Jayme, Mika. Other important information for those that are virtual today is code words and CPE. In-person attendees do not have to worry about code words. So this is not for you. There will be 8 code words spread throughout the presentation. And as you'll see, virtual attendees must submit 3 of the 4 code words for each CPE credit. Okay. So again, there'll be that 10-minute intermission halfway through, and virtual attendees, again, insert any of your questions you may have in the Q&A section, and we have folks monitoring that, and they'll read those questions to us, and we'll be sure to answer those. And lastly, I'll just say specific to questions, feel free to ask them throughout the presentation. We do have slides at the end where you all can hold your questions, but we'll take them as we go if you all would prefer to ask them that way. And with that, I'll turn it over to Courtney to get us started.
Yes, thank you, Richard, and thanks again for all of you for attending today. As he mentioned, I'm going to be covering gifts in kind, which is actually one of the new updates that did come out by the FASB in 2020, and I will give a refresher, give some background on gifts in kind, and then get into the new requirements. So yeah, like I said, first I'll start with a background on gifts in kind, and then I'll get into Accounting Standard Update 2020-07, presentation and disclosures by not-for-profit entities for contributed non-financial assets. What's new? And then after that, I will get into some audit and tax prep that you all can do to help when you come around to that time. Fonda, I think there might be a camera issue. Okay. All right, so starting with the background. So what are gifts in kind? Gifts in kind are a type of charitable giving in which the donor gives goods or services to the recipient organization instead of cash. They're also referred to as contributed non-financial assets or in-kind donations. So some examples might include fixed assets. Maybe land was gifted to your organization, or a building or equipment for use in your mission. The use of fixed assets or utilities. For example, you have maybe free or reduced rent. Materials and supplies, food, clothing, pharmaceuticals that are donated to your organization to help with your mission as well. Intangible assets, maybe a patent or something like that, or advertising, free advertising. And there are also recognized contributed services, which we will get into in a couple slides. So first of all, some factors to consider when recording a contributed good. So the recipient has to have discretion in using or distributing the gift in kind. So that usually means that the organization, the recipient, has risks and rewards of ownership over the gift in kind, such as the risk of loss if the good is lost, damaged, or destroyed, and also the ability to obtain the benefits of and control others' access to the gift in kind. So typically this means that the organization is taking physical possession of the gift in kind, or they could also take constructive possession. For example, these goods are housed in a warehouse with a third-party warehouse that they own or they have access to. There are also services or factors to consider when recording contributed services. So if the service is related to a non-financial asset, it must create or enhance the asset. So this includes, like I said earlier, land, building, use of facilities, utilities, materials and supplies, intangible assets or services. So for example, if somebody is helping replace a floor, that actually will create or enhance a non-financial asset of your building. So that would be considered a gift in kind. But if someone is just cleaning the floor, that might not actually create or enhance the non-financial asset and therefore would not have to be recorded as revenue. So these services must require specialized skills, be provided by individuals possessing those skills, and must typically be needed to be purchased, if not otherwise provided by the donation. Specialized skills are provided by accountants, architects, carpenters, doctors, electricians, lawyers, nurses, plumbers, teachers, and other professionals and craftsmen. Here's a list of frequently missed gifts in kind that you definitely want to check over and make sure that your gifts in kind that you're recording are complete. So as I mentioned earlier, advertisement and radio time. This is an intangible asset that is recorded as revenue. Contributed uses of facilities and utilities, contributed personnel costs from an affiliate, contributions for fundraisers, contributed administration costs, contributed collection items, and below market interest rates. And that's one that I see a lot. If somebody is, given a loan at a interest-free or very low interest rate, that interest that would normally have been required to be paid in a normal market would be recorded as a gift in kind. So as Richard mentioned, we have code words throughout the presentation. This is your first code word. So enter 484 and it'll actually be included on the next slide just in case you miss it. All right, so when and how are gifts in kind valued? So they're recognized at the time of receipt and they should be measured at their fair market value. And fair market value is the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. So the best support available would be a quoted price in an active market. If if someone donates a building to your organization, the similar prices of similar buildings in the same market, that would be a great support for what the value is of that building. Organizations often accept gifts without the intent to sell. So it doesn't matter if the organization plans to distribute the goods. That doesn't mean it doesn't have value if they're planning to give them away for free. So if a shelter is given food and this food is going to be given to people that live at the shelter, that doesn't mean that the food has no value. The organization needs to identify the principal market for the gift. So this is defined as the market in which the organization would sell the asset with the greatest volume and level of activity for that asset that the organization is able to access. If there is no principal market, assume the most advantageous market. And then the next couple slides are just items about the value. And for example, what if an asset's usefulness indicates its principal market? So gifts in kind may address a need which exists primarily in the developing world. When that's the case, the developing world would be the market for fair market value purposes. It might not be the most advantageous market in this case. So if it's a good that, for example, a pharmaceutical that's only going to be sold in a developing country, or only going to be given in a developing country, but it could be sold for much more in the United States. If it doesn't really have much of a use in the United States, then the value that would be considered is the value in that developing country. Another thing to consider is legal restrictions, but not donor restrictions. So donor restrictions do not affect the marketplace price. That impact is on net asset classification. For example, if someone donates to your organization cars that are only to be sold or given to low-income high school students, for example, that might not be the most advantageous market, but there's a donor restriction on there that says you can only donate there. So it's going to be considered a revenue with donor restriction, but that doesn't mean that that's the value that needs to be held. It can still be held for what typical cars would be sold in the regular, wholesale car value in the area or something like that. The organization should, however, consider the characteristics of the asset, including legal restrictions on any holder of the asset. So if the organization is gifted pharmaceuticals, there may be legal restrictions to consider when determining the hypothetical market for participant buyers. So you can't value it at a value that you wouldn't be able to sell it due to restrictions. So on the next few slides, I'll get into the new required disclosures with ASU 2020-07. But prior to this new standard, the disclosure requirements existed only for contributed services. So you had to disclose the programs or activities for which the services were used, the nature and extent of the contributed services received for the period, and the amount of revenue recognized for the period. Organizations were also encouraged to disclose the fair value of contributed services received, but not required to be recognized as revenue, if practical. So that's kind of a background on what gifts in kind are, how they're valued, and required disclosures prior to ASU 2020-07. Now I'll get into the new ASU, which is called Presentation and Disclosure by Not-for-Profit Entities for Contributed Non-Financial Assets. So first, a quick background. In September 2020, the FASB issued ASU 2020-07, presentation and disclosure by not-for-profit entities for contributed non-financial assets. The amendments in this update are effective for annual financial statements issued for fiscal years beginning after June 15th, 2021, with early adoption permitted. So for your June 30 year-end organizations, this would be for June 30th, 2020, the year ended then. And then for December 31st year-end entities, it would be December 31st, 2022. So it actually is effective as of January 1st, 2022, but your financial statements will be for December 31st. So these amendments should be applied on a retrospective basis and applied to all periods presented. So if you're presenting comparative statements, 2-year statements, you need to include these disclosures for the previous year as well. And it's important to remember that the underlying accounting for contributions of non-financial assets remains unchanged. The fair value requirements are still the same. The new ASU is simply for disclosure requirements. It aims to increase transparency of gifts in kind through enhancements to presentation and disclosures. So now some of the requirements of ASU 2020-07. Gifts in kind are now required to be presented as a separate line item on the statement of activities. So previously, these may have been included and grouped in with regular contributions. Now you'll have a separate line item for contributed goods, contributed services on your statement of activities. And then some other requirements that are actually disclosures in the footnotes. So the previous disclosure requirements, as I mentioned before, were less detailed, primarily related only to contributed services. The new, more detailed requirements are for contributions of all non-financial assets, both goods and services. Under the new guidance, organizations must disclose the following in their financial statements. Must disclose a disaggregation of the total amount of contributed non-financial assets recognized within the statement of activities by category. So for each category, the following must be disclosed. And by category, I mean building, automobiles, food, clothing, services. Those are example categories that you might see. So for each category, you must disclose qualitative information about whether the contributed non-financial assets were either sold or held for sale or used during the reporting period. So if used, the organization must disclose a description of the program or activities in which the services were used or assets were used. And the organization must also disclose the policy, if there is one, about monetizing or selling rather than using the contributed non-financial assets. For each category, you must also list a description of any donor-imposed restrictions associated with the contributed non-financial assets. You also must include a description of the valuation techniques and inputs used to arrive at the fair value measurements in accordance with Topic 820 fair value measurement. And finally, if the principal market or most advantageous market is used to arrive at fair value measurement, you must disclose it if it's a market in which the recipient organization is prohibited by a donor-imposed restriction from selling or using the non-financial asset. So this goes back to my example of the cars. If the donor restriction is that the cars must only be sold to these low-income high school children, you have to disclose that is the donor-imposed restriction, even if that is not the way you are valuing the cars. So here's just an example of what you would see in the footnotes. And this is in a tabular chart format, but you can also include this information in paragraph form. It doesn't have to be a chart like this. But you'll see that you have a listing of all the different categories. So you have buildings, household goods, foods, pharmaceuticals, so on and so forth. And then after that, there's a description of the actual goods and how they're valued. So for example, the building is valued using similar market, the market for similar homes in the Richmond area. And then it'll go on and list that for food, for all of the different types of goods. And then final words on the new ASU. While it may seem burdensome, this really just brings disclosures for contributed non-financial assets in line with other disclosures that are required for contributions of financial assets. And it provides insight to the readers of the financial statements as to how fair value for contributed non-financial assets is measured. And really, a nonprofit organization should already be considering these factors. You should be considering the fair value when you're recording these gifts in kind. All this is aiming to do is put those considerations into the financial statements so that readers have an understanding. And it's important to be prepared when it comes around time for your audit and your tax preparation. This information needs to be provided to us so that we can do our job. So here's some examples on how to prepare for your annual audit and tax work. You must prepare a schedule of all the gifts in kind received during the reporting period. So on this schedule, you want to include the fair market value of each gift. And review the listing for completeness and proper year-end cutoff. Go back to that listing I showed of frequently missed gifts. Did you forget to record some advertising time that a radio allowed for free? Make sure that's included on the listing. Document the valuation methodology, including any assumptions made. This information is going to have to get into the financial statements somehow, so it's much easier if it's ready when your audit team or your financial statement prep team is getting started. Have accessible all donor and vendor agreements. If there was a contract or a agreement in line with the gift in kind that was provided, if there's any restrictions there, make sure that information is ready for your auditor, your accountant, your tax preparer. And then, of course, ensure restrictions and conditions are properly recorded. So ensure any proper release of capitalized gifts in kind. If those restricted cars that were given to you were then sold, make sure that they are released from restriction and then included as a expense on your financial statements. And with that, that's all I have for gifts in kind, but I'm happy to answer any questions. So please, if you're virtual, send some questions into the chat. And if you're live here, happy to answer any questions. Yes, Mike.
So on your financial statements, do you have to disclose services, contributed services separately from contributed goods?
On the income statement?
Yeah.
I believe so, yes. Yeah. Yes, Fonda.
We do have a question from a virtual audience. And the question is, are gifts in kind reported as miscellaneous non-operating income?
No, they would be so on the financial statements, they would be included with your contributions. So at the top of the financial statements with your regular contributions and revenue in that way. Anything else? Anything else virtually? Okay. All right. Thank you. And yeah, thanks again for your time. Now I'll turn it over to Preston.
Thank you very much, Courtney. First, just wanted to introduce myself a little bit. I'm Preston Jones. I'm a senior manager in our business assurance and advisory services group. That's mostly performing audits, and then a few other assurance and advisory and attestation types of engagements. Been at Keiter for 10 years, been in our not-for-profit industry group for 6 or 7 now. So it's definitely what I do the most of is not-for-profit accounting and reporting. And so I'm excited to be able to share some insights with all you guys today. And I wanted to revisit a little bit of Courtney's presentation and just kind of say a little bit before I dive into mine about the particular topics that we chose to present on. We were kind of trying to think, well, what are the pieces where, it's easy for us as auditors to audit the things that are there and that you can touch and that are in the record so cleanly that we can pull invoices and test that, we can pull bank statements and test that. And we were trying to kind of think, well, where can we provide some insight for the stuff that's a little harder for us to see at first glance and a little easier for you guys as management at your companies and the accounting and financial professionals at your companies, the things that we kind of need a little more help from you guys on, the things that we can't see at first glance. And so like Courtney talked about the commonly missed gifts in kind, that can be something where if you're not thinking that you need to record it, there might not be something that jumps out to us as auditors and tax preparers and CPAs without seeing the day-to-day of the company. And so I hope this whole time you kind of have that in the back of your mind. And then when you're doing your year-end reporting, that you're kind of thinking through that. Well, what are the other pieces that, you can reconcile the books every month. What are the other pieces that maybe not showing up that you need to get in there? And so the topic that I'm going to share that kind of relates into all that is revenue recognition. And unlike Courtney's, which was kind of forward thinking, this new standard that came out, mine is a little kind of retroactive thinking. There's been a big standard that they kept delaying it, topic 606. Oh, sorry, we have the code word ready to go for this one too. So code word number 2 is 175. Give everybody a minute on that. And again, if you're here, you don't need to worry about the code words. And it'll be on the next slide too, if you miss it while we're talking here. So there we go. Revenue with contracts with customers, topic 606. That was the big revenue recognition standard. It was kind of considered one of the biggest changes FASB had made in a long time, certainly in my career as an accountant, as a new way of recording revenue across the board. And it was universal. The idea was wiping out all previous revenue recognition guidance across any industries, replacing it with this new way of doing it, topic 606. That went into effect a couple years ago. They delayed it a little for private companies to let the public companies kind of go through the growing pains first, and then private companies could learn from a little bit, including not-for-profits. And then when COVID came along, FASB kind of said, well, everybody's kind of got enough to deal with. I don't know that revenue recognition standards need to be top of mind quite yet. So they delayed it a little bit more, but everybody should have this one at this point. It's implemented across the board now. But then after implementing 606, they kind of realized, well, maybe there is a little bit more fine tuning. So then we're also going to talk about ASU 2018-08, which is a little more recent, but again, it is in effect, or topic 958, which is clarifying the scope and accounting guidance for contributions received and contributions made. So that's where it gets more into the details of not-for-profit accounting. So I'll kind of provide some background on all of these, kind of some best practices and what we've seen so far. And then similar to Courtney, so what can we get from you guys and what can you guys get from us to help when it comes time for financial reporting, audit, tax prep, all that good stuff. So topic 606, revenue from contracts with customers. And again, none of this is new. This is a standard that's been put in place. So hopefully you've heard this stuff, but if not, I wanted to give a little bit of a refresher. It sounds pretty technical, but once we got the hang of implementing it, to be quite honest, we did see a lot of changes in the debits and credits accounting. It seemed for the most part, most of our clients end up recognizing the same revenue each year that they would have before, and ended up hitting more in the footnotes and the disclosures than the accounting itself. But again, what FASB wanted to set up was a principles-based new revenue recognition model that follows a 5-step approach. And so by principles-based, they mean instead of all the specific rules across all the different industries of how you recognize revenue, it's more of a concept. This is the appropriate way to do it, and everybody should be able hypothetically to do it this way. So the 5 steps, you can see them on the slide. Identify the contract with a customer, identify performance obligations within the contract, determine transaction price, allocate the transaction price to the performance obligations, recognize revenue when or as each performance obligation is satisfied. And I'll kind of walk you through that a little bit to show you what that looks like. The first step, identify a contract with customer. That one's pretty straightforward. It's what it sounds like. You need to have an agreement in place, and the way FASB defines it is an agreement between 2 or more parties that generates enforceable rights and obligations. And so it's just when you have 2 or more parties and they agree that somebody owes somebody something else, that's a contract where you're going to have to go through this step to determine how to recognize the revenue. Step 2 is identify the performance obligations in the contract. And so performance obligations was a new term, I believe. And it's to say, what are any of the little pieces in this contract that the seller is providing to the person receiving the benefit. And so for some reason, the example that always makes it clear to me is I always think of an HVAC company, somebody installing AC units. For a long time, you think, well, they're selling an AC unit. So they sell it, revenue, you're good. But then if you drill down a little bit more, you look into these contracts and you can say, well, what could be the performance obligations in this? It could be the AC unit itself. That's obviously one. It could be delivery. It could be installation. It could be some kind of service contract or warranty period, maintenance contract, annual maintenance checkups on your unit. And any of those could be a performance obligation. So, in something like that, probably looking at like 3 to 5 performance obligations, maybe. And then each one of those is going to have to kind of have its own analysis of how you recognize the revenue. The next step after you determine each of those performance obligations is determining the transaction price. And so that one got a little more in detail as well with this topic 606, with this new idea of variable consideration. And variable consideration basically means instead of just kind of the face price on a contract, you have to keep in mind, potential ways that ultimate realizable price might change. So you have to kind of do this analysis of how much do I actually expect to end up collecting on this contract. And so it could incorporate things like a bad debt allowance or rebates or returns or something like that. It could be renewal periods. You can factor that into if it's going to be renewed, you kind of present value all of that into the total transaction price. Things like volume discounts, like if you lease copiers and maybe you charge a base monthly rent for the copier and you charge a percentage of use or a number of copies type thing. And if they hit, 1,000 copies a month, it's at this much per. If they hit 5,000 copies a month, it's this much per. All of that goes into this initial analysis of determining the transaction price. Once you have that transaction price, you're going to allocate that total transaction price to each performance obligation. And this is when you have to start busting out your calculators and really doing some math. The way it works is, so let's talk about that AC unit, that HVAC company. You have a price for each performance obligation. You're going to end up with a price for transferring ownership of the unit. We'll say delivery and installation, and we'll say they had a 5-year service contract where they're going to come and check it every 5 years. The total price was $2,500 for the whole thing. And so how do you allocate that total transaction price to each performance obligation? Kind of the best way of doing it, and the way that we hope can be reached, and usually can, is looking at standalone pricing. Because in all likelihood, if you have different performance obligations, you'll have some kind of standalone price for that. And so that's, can you come up with a price for what just the unit would be without delivery and installation, without a maintenance contract? Can you come up with a price for what just delivery and installation would be? And can you come up with a price of what just the performance contract would be? And so that's, let's say each of them individually, the unit, if you just bought the unit, is $2,000. Delivery and installation, let's say you have a unit, you need them to bring it here and install it, is $500. Maintenance fee is $500, $100 a year for 5 years. You would take that total, so that's $3,000 total if each of these are standalone. The unit itself is $2,000 out of $3,000, 67%. The delivery and installation is $500 out of $3,000, 33%. 16.5%. And then the service fee is another 16.5%. You then take those percentages times the price of what you've determined as the total transaction price for this contract, times that $2,500, and allocate it accordingly. So I know I went through that kind of fast, but hopefully it makes sense. And again, hopefully you guys have been implementing this already. And then you recognize that revenue when or as each performance obligation is satisfied. So you look at, well, we have these 3 distinct performance obligations: unit itself, delivery and installation, service contract. You've come up with the total transaction price to each obligation. And so the way you do it is that as soon as title transfers, whatever that barrier, that obligation is, you recognize that big 66% of the total transaction. Then as soon as they deliver and install, then you recognize that next piece of it. Then that service contract is probably going to be more like something that's over time instead of a designated period. You know, it's going to be a little under 100 the way I said the math, but per year. And so you can't continue to recognize all that revenue until you're meeting each one of these performance obligations in the contract. Anybody have any questions about this in particular? Again, we can do questions at the end, but this was a big new thing a couple of years ago. I'm going to talk a little bit more about it, but just this process. Requires a little bit more disclosures in the footnotes as well, and even on the face of the financial statement. So appropriate disaggregation of revenue into categories that depict how revenue and cash flows can be affected by economic factors. Basically kind of similar to what Courtney was saying about the gifts in kind. It's likely that you need to disaggregate your revenue a little bit more. And that whole idea affected by economic factors of just how could changes in the industry, how could changes in the socio-political environment, you know, how could outside changes affect each of these lines of revenue, and if areas have similar ways that they could be affected and similar ways that they could change, they're likely the ones that need to be grouped together. If they have different ways, then they should probably be disaggregated. Disclosure of opening and closing balances of contract balances. So this new approach kind of can, again, we didn't see a lot of changes in net debits and credits, but it can affect the timing of when you're recognizing revenues. And that can result in deferred revenue when you're getting cash, but you can't recognize it as revenue yet. Or the inverse, where you're recognizing revenue early, even though you haven't got the cash yet. And so those are what we call the contract balances, and you have to disclose those in the financial statements. And then some pretty, you don't have to get too specific, but some broad explanations about your performance obligations and kind of when you expect to be meeting those performance obligations on existing revenue contracts. So that was topic 606, went into effect a couple years ago. The idea was, again, this new principles-based, all-encompassing revenue guidance. And it's fine. This kind of makes it sound worse than it ended up. It is fine, but it turns out you can't be as all-encompassing as you think you can be. It just doesn't really work that way. Like, there's a reason sometimes we have some nitty-gritty specific rules. So confusion came up, questions came up. Well, we always handled this way. How do we do this under the new guidance? So what we're talking about today is not-for-profits. They quickly released ASU 2018-08, not-for-profit entities, topic 958, clarifying the scope and accounting guidance for contributions received and contributions made. Because really that's, there's a few things, but this idea of contribution revenue is one of the big thing that distinguishes not-for-profit accounting from for-profit accounting. I can definitely tell you in my own experience, when I see people coming from for-profit and coming to be a director of finance or a controller or comptroller at one of our nonprofits, that is something that takes an adjustment period sometimes. Really good accountants, but they just don't always have that not-for-profit mindset of how to account for things like contributions. It doesn't really sync up with what they've practiced for years. So I want to dive into that a little bit as well to say what they kind of clarified with that guidance. Now it is mostly very similar guidance to what was pre-606. Contributions obviously is not a new accounting topic, but they fine-tuned it a little bit, and some of it was kind of reinforcing ideas that we already knew and codifying it a little bit. So again, that whole idea, primarily nonprofits, the reason they weren't syncing up with topic 606 was this exchange transactions versus contributions, where you'll see the wording reciprocal versus non-reciprocal. And so what topic 958 did was kind of add a step 0 to that 5-step process. And step 0 is this first analysis of, is it an exchange transaction or contribution? Exchange transaction obviously being reciprocal, it means kind of each party is getting something out of this. Contribution is non-reciprocal, it's kind of one way. Now there could be kind of some other ancillary benefits, but it's not equal value by any means, it's not reciprocal. Exchange transactions, that's what you identify. If you identify something reciprocal in exchange, you do that new topic 606 guidance, that whole 5-step process, performance obligations, all that fun stuff. Contributions, you do this topic 958, which again, it's pretty similar. If you've been in the not-for-profit world, if you've been doing contribution accounting, it's not too different, but they kind of recodified a few things. So then the big question is, well, how do you identify it? How can you determine if it's an exchange transaction or contribution? And it's not always super clear. There's times where we really have to dive into contracts and really have conversations with our clients about kind of what each party thinks they're getting out of this. You can see the definition though in the guidance: a transfer of assets that is unconditional, voluntary, and non-reciprocal. So it's all that idea of it's not reciprocal, it's one way, it's freely given. Something like a government penalty is something that would be non-reciprocal. Only one party's getting something, the government's getting cash, but that's not something that's voluntary, so it's not a contribution. And then the big question that's asked in the guidance is commensurate value being received. Both parties getting something out of this, and are they getting something that's roughly equal in value? They make a few clarifications or a few fine points. A benefit received by the public as opposed to the resource provider is not commensurate value. So if you have, if you have some organization that outfits bus stops with new benches and new awnings and new lighting and something like that, they're providing value. It's not just cash changing hands for the sake of a contribution, but that value is going to the public. Even if the resource provider was using these bus stops, since that value is going to the public, it's not commensurate value. And then, on a very similar line of thought, execution of the resource provider's mission is not commensurate value, just because the money kind of going towards what they want it to go towards. And they have common goals, that's not commensurate value, that's still going to be a contribution. And then a couple other indicators to consider. These do come from the old gap, the previous contribution guidance, but they're still pretty good. If you kind of need further diving into, well, I can't quite tell if this is an exchange or a contribution. The big one, intent in soliciting the good of the service provided, which can be subjective, but if you can be reviewing communications, reviewing contracts, a lot of times it just comes into, well, what was the intent? What were these people trying to do? Was this supposed to be a contribution, or was this supposed to be an exchange where they're each getting something out of it? Who is receiving the value? That's very similar to who's receiving the benefit, and who determines the amount of payment. So if I'm giving you money for something and I'm deciding how much money I'm giving, it's likely I'm giving you a contribution, not definitive, but it's likely. If you're telling me, hey, you need to give me this much money, it's likely that it's an exchange transaction. So who's determining that amount of payment between the two parties? So then let's say we figured it out. We know we have a contribution. Topic 958 continues to go into conditional versus unconditional contributions. So unconditional contributions, given freely, voluntary, nothing extra, those you go ahead and recognize as revenue. Conditional contributions, there's a little bit extra, and you're likely not going to be recognizing this as revenue quite yet. You can see the way they define it. Conditional contributions require one or more barriers to overcome to be entitled to assets transferred or promised, right of return for assets transferred, or right of release from obligation to transfer assets. So what does that mean? That means a barrier to overcome means something else has to take place before you've really gotten this money. And you may have the money, and that's to overcome to be entitled to assets transferred. You already got the money, but you're not entitled to it yet until this other thing happens. Or promised, if it's a pledge or a promise to give, they're not going to give it until this other barrier has been overcome, this other thing has happened. And you'd even have that right of return, you'd have to give the money back, right of release from obligation, they no longer owe you that money. So how do we figure that out? How do we determine if it's conditional or unconditional? First, code word number 3, 657. And I'll give you guys a minute, and it'll be on the next slide too. So here are some examples of barriers. We said conditional contributions have a barrier to overcome. They can be a few different things. It can be a performance barrier or a level of service, which is generally going to be some kind of quantitative outcome or need. So like the example we have up here is a certain number of students enrolled in a program, let's say like an SAT prep program for high school or something. Somebody might say, I'm going to give you $5,000 to support this program, but I got to see that you sign up at least 250 kids for it. Otherwise, I need that money back, or you need to sign them up first and then I'll give you the money. Something like that is a performance barrier or a level of service barrier. It could be a specific outcome. So kind of along the same lines, students achieving a specific test score. Yeah, I'm going to give you $5,000 for this program, but I need to see that the average SAT score in this group was at least 50 points higher than the average SAT score for your students who are not in this group. So a specific outcome that's required. Be matching funds. That's probably like the classical example and the one that we've probably seen the most over the years. And companies running them, usually it's like a big capital campaign or something like that. And they say, well, I'll give you $1 million, but only if you can raise $1 million outside of it, or I'll match up to $1 million, something along those lines, where you need to be bringing in other money, but this big donor will match it or even exceed it themselves, but only after you've raised all that money. All of those are examples of conditions or a barrier for your contribution. Or if you don't do this other thing, you're not going to be entitled to that money. Outside events, and that could be just kind of other things the organization is doing, or it could even be other things that the organization doesn't even have control over. It could be something like when there's pending legislation or something like that that might prove burdensome on a nonprofit. If like a COVID thing, if they need new new tech supplies or something, and we've been dealing with something similar to that recently. But let's say there's this pending legislation that's going to be burdensome for a nonprofit. Somebody could say, if this legislation comes to pass, I will give you $200,000 to help implement whatever this new burdens are for you. And so that outside event needs to happen, and then you'd be entitled to this money. I mentioned we've been doing something similar. We've done a lot lately. We do a lot of audits of private schools, and a lot of them got grants to aid in some COVID. A lot of the remote learning stuff, they got grants to get laptops and iPads and like Zoom subscriptions and that kind of stuff. And a lot of it is for purchases they're continuing to make, but they get it approved. They get all those purchases approved by the government giving them this grant. They get the purchases approved ahead of time. And those, when we did our analysis, we all came to the conclusion that those are conditional contributions where they have all this approved, they've been granted the money, but they need to go purchase those assets. Then when they go and purchase those assets or those subscriptions or whatever it is, cleaning supplies too, once they purchase those things, then they are entitled to that money. So then it becomes revenue as a conditional contribution. And then this last point actually is a change from the old conditional contribution guidance. the likelihood of overcoming the barrier is not a factor in applying the guidance. It used to be that if something was, almost a certainty of happening, like even though it was a barrier, you could still go ahead and recognize it as revenue. You didn't really call that a contribution. That's not the case anymore. If you have a barrier, you have a barrier. Likelihood doesn't really matter. Disclosures under topic 958. So all the contribution stuff and the disclosures primarily relate to, we have promises to give up here. We say pledges receivable a lot too. It's the same, essentially the same thing. Weren't any new disclosures from the guidance, but just kind of reinforcement of existing disclosures from the old guidance. We have conditional promises to give. So conditional pledges, the one that you haven't recognized yet. You have to disclose the total and a description and amount for each group of promises with similar characteristics. So that just means you can't just say they have 500,000 of conditional contributions when it relates to 4 or 5 different things. You have to kind of group them together and give a little separate disclosure of each one. Unconditional promises to give, unconditional pledges. This is all consistent with the past. Amounts receivable in less than a year, 1 to 5 years thereafter. Amount of an allowance, you have to do an allowance analysis just like you do for trade receivables, and discount to present value. If you have stuff long-term, stuff over a year, you need to do an analysis if a discount to present value is material. So once you carve out all that contribution stuff, when it comes to nonprofits, what's left for topic 606? It could be a number of things. It depends on the organization. We listed kind of a few of the most common ones we've seen the last couple of years up here: tuition, fees, membership dues, gift shop, special event income. But really it kind of depends on you, and you guys need to be doing that analysis and talking to us about that analysis. And generally, rule of thumb, if it's revenue where the contract happens, the revenue is received, and it all happens less than a year, it's pretty unlikely that you're going to have any significant changes from this. It's that stuff that's long-term that kind of requires a little more analysis. I don't want to say it can't happen if it's short-term stuff, it just makes it less likely. And then an important point, certain revenue streams could need to be bifurcated between the 2 different standards, between 606 and 958. That happens most likely or most commonly when we see it in things like membership dues or special events, something where you pay an annual membership, but really a portion of that is probably a contribution. You're not receiving commensurate value, but you are receiving some value. Or similar like special events, you pay to get tickets to go to an event or participate in an event, like a golf charity event or something like that. It's $200 to participate and costs $200 to get around the golf. And so it might need some analysis there under both of the standards to make sure you're keeping up with the new gap. And so then similar to Courtney, I kind of just wanted to give some tips and some best practices of, we do all this accounting during the year, but then year end is when we really hit the crunch on financial reporting and auditing and tax returns and all that. So how can we make that process smooth? The biggest thing, keep an ongoing inventory of your revenue streams. So just take some time to think about your different revenue streams. Think about that idea of the different economic factors and the way they need to be grouped and the way they need to be analyzed. For each of these revenue streams that you identify, review related contracts. I know everybody doesn't always have contracts for each type of revenue they receive, and that's fine. But for those that you do have it, review the contracts, summarize the key factors, try to think about that idea of performance obligations and variable considerations. And then between the audit standards, your own research, your resources here at Keiter, you can call us, you can email us. We have a blog that we've posted a lot of stuff about this on over the years to determine these proper classifications, determine what footnotes you might need, stuff like that. And revisit regularly. Try to just keep it in the back of your mind. Whenever something does change when you're with your revenue, whether it's new lines of revenue or new contracts or even new significant customers that might kind of require extra analysis, keep revisiting this. And so then a little specifically for topic 606, again, that mindset of those economic factors and ensure you have proper disaggregation. It really helps if you have a write-up for each type of line of revenue that you have. When you do audits with us, we always do our walkthroughs. The more specific we can get on those, probably the better. And so, if you have these internally already, you can provide them to the audit. It helps you kind of have insight that you might not have thought of about your own revenue processes. And it definitely helps us as auditors and tax preparers to see a little more of each step of the transaction rather than, we look at the GL, we see the revenue recorded. Having just a couple paragraphs really helps us kind of gain an understanding of how it all works. Wherever you do have contracts, try to have some examples ready for review during year end. We're probably going to want to look at one and make sure we come to the same conclusions you do. And as you're doing your own analysis, just kind of try to think of questions ahead of time. You can reach out to us anytime or just have them ready for the audit. Just always helps you guys. You know, you're in it a lot more than we are. So your questions we'll both be able to provide insight to you by answering your questions, but we'll also get insight from you by hearing the types of questions that you have for us. And then contributions, topic 958. Read your grants really carefully. Barriers can be subtle. A lot of times it can be a pretty subtle distinction between, is this a barrier to overcome, making it a conditional contribution, or is this a restriction on the contribution? Is this just kind of a category that these funds need to be used for? In that case, you do record it as revenue with those restrictions. A big thing is try to have a lot of communication between finance and development or advancement, or your fundraising arm, your fundraising personnel. There could be things that one group knows that the other group doesn't. Finance has their records, advancement has their records. Make sure those are all syncing up. Again, that's the idea of kind of what I said about Courtney. You might have conditional contributions, or you might have pledges where, because money hasn't come in and hasn't made its way to finance and accounting, but the fundraising team knows about it. It's going to be hard for us to audit if the accounting and finance team doesn't know about it. So make sure you guys are having those internal conversations prior to us coming on board. And then just something to kind of streamline our testing and the financial statements and everything, a full roll forward of promises to give or pledges, your beginning balances, your new pledges, your payments received, your ending balances, and then a schedule of those future payments. We need to look at allowance, we need to look at a discount. And then that's something that just helps kind of streamline the whole process for everybody. So that's revenue recognition, both 606 for your exchange transactions, 958 for your contributions. I'm happy to answer any questions. No? So we're just about ready for break. I think we actually have, yes, we have one more code word right before break. So code word 4 is 906. Yes. So we have a break, 10, 12 minutes. I think 10 a.m. is probably still a good time to come back for break. Thank you.
All right, well, welcome back. I hope everyone enjoyed their intermission and now is ready to kind of undertake a couple more topics on the accounting side, as well as touch on the tax side this morning. So I'm going to start with functional expense reporting. Kind of selected this topic for a variety of reasons. I think when I think about, well, we're getting ready to do the audit and we have all this information that we're asking for, generally this is one of the last requests to come in. And I believe it's for a couple of reasons. One is it's probably not the, one of the easier, most popular items. So I think there's a burden associated with preparing it. And also, there's probably not a lot of perceived value. It's not something that's being maintained internally on a month-to-month basis. So it's really just very audit specific. So I thought maybe if we talk about it a little bit this morning and maybe take a little bit more proactive approach to it around it, maybe it won't be it'll be a little bit more popular in the future moving forward. So with that, I want to just kind of briefly talk about why it's important. And this is kind of the FASB definition of why it's important. Whoops. This is the FASB definition. And, I don't plan to kind of read through this, but a couple of things that kind of come to mind for me is obviously it's important because it's required. That's, bar none, a couple of years ago, the FASB came out with a new, not-for-profit reporting model, basically mandated this for all not-for-profit organizations. So that's kind of the baseline reason. But also, I think it can be used as another management tool along with the other, statements that we all, everyone likes the statement of financial position, the statement of activities. Well, this kind of gives you a little different look, the functional expense schedule at your expenses, and in some ways lines it up more with, how you may be doing your month-to-month budgeting internally with salaries, rent, et cetera. So it's an opportunity to kind of look at what's in the financial statements and how it lines up with what you're doing internally and how you're reporting internally. And also it provides an opportunity for the not-for-profit organization to tell its story in another way and in another place in the financial statements. There aren't a ton of opportunities in financial statements to tell your story. So when you're doing your functional expense reporting, you can go into some details around your different programs. You can just have, one column there of your program services, or you can decide to maybe break out your 2, 3, or 4 most significant programs, and then maybe have another catch-all column or something like that. But that's an opportunity to be a little bit more transparent with anyone who may be using your financial statements. And then you can kind of take that a step further and kind of go into some details in your notes around the various programs and some outcomes and that sort of thing, if you want to, use the financial statements to, again, tell your story in a little bit more, transparent way. Of course, program services, we're all, pretty familiar with that. I did just now mention, and I'll just mention it again, that, many organizations elect to just have kind of a singular column of program services and kind of have a catch-all there. But there are certainly opportunities to kind of break that down in the statement of functional expenses or in the notes to provide a little bit more detail. Again, your 3 or 4 most popular or most significant, I don't want to say popular, your most significant programs, if you want to kind of capture those separately, that could be helpful to anyone who's, using your financial statements, whether it's grantors or certainly donors, that sort of thing. And then the second, the second big category here is supporting services. And, I know, and we'll talk a little bit more about this, that there's always, a push to have as much, as many expenses as possible in that program category. And that's important to, rating agencies, it's important to donors, all that sort of thing. But really, a nonprofit, and most people, if they're giving to nonprofits, understand that you can't have a healthy nonprofit if you are not supporting it appropriately with infrastructure that comes in the way of accounting, HR, and any sort of other overhead type items. And that's where those types of expenses, this is where they fall out. So of course, management in general, fundraising, and then membership development activities, which is not one we see a ton, but it is something that, if you have memberships at your nonprofit, you are probably spending some resources towards, bringing members in and then also maintaining relationships with those donors or with those members. That all would fall under this membership development activities. And for, certain organizations, it's not really a material amount, so probably or potentially not worth, having a separate, column or category for it. But it is an option and an opportunity. And if those expenses are currently being captured in management in general, for example, or maybe even in fundraising, it may be worth breaking that out, because again, it tells a little bit more of your story and how you're using your resources at the nonprofit. On the fundraising piece, this isn't always the case, but generally speaking, if you have contributions, then you should probably have some fundraising expenses. Every once in a while, we'll have an organization that doesn't, put any effort towards fundraising. They just have a few checks come in the door each year. They're kind of legacy type gifts, and that can make sense. But generally speaking, if you've got contributions, a rule of thumb, you've got some level of effort to maintain those donor relationships. And of course, hopefully trying to work to grow your contributions. So making sure that you're showing that separately is really, really important. All right. Digging in a little bit more, and I already mentioned that this piece of management and general activities, a couple of examples here. And again, it's really just your overhead. And historically, prior to kind of the not-for-profit reporting model coming out and kind of mandating this schedule, the accounting, the human resources, people came up with, or organizations came up with very creative ways to be able to allocate those to programs. The rule of thumb that came out of that was very much clearer that they thought accounting, HR, all that sort of thing, there really wasn't an opportunity to allocate that should, fairly rigidly be a management and general expense. Certainly your CEO is an element of your overhead, but they probably, and most likely, especially in smaller organizations, are providing oversight of the programming area. They may be doing fundraising themselves, but at a minimum, they're providing oversight of fundraising. So there's certainly the opportunity to allocate your CEO salaries, but your CFO, your controller, any other accounting personnel, HR resources, that sort of thing is management in general. And, we still see, some organizations trying to do some allocations there, and we just kind of have to talk through that because the guidance is now pretty clear on that front. Not a whole lot more to add on the fundraising activities. You can see several examples here, but anything that efforts you're undertaking to raise money for the organization, you need to capture that time and any of the costs related to that in your fundraising. And I thought this may be a good opportunity to just bring up the concept of joint cost or joint activities. There are certainly situations where you may be doing some fundraising where you're trying to incorporate or include an element of program. And so the gap criteria, the FASB criteria around that is pretty clear that those items should be fundraising, those efforts should be fundraising, unless there's really three specific criteria met. One is purpose. So, think about it, if you're sending out a fundraising appeal and you want to have a program element to that so that you have the opportunity to do some allocating, you have to have a call to action within that purpose. So the example that we kind of hear when we attend CPE sessions is generally around, smoking, and whether, you're an organization that maybe focuses on trying to, get people to stop smoking, or maybe, cancer research, that sort of thing. And the call to action couldn't just be, facts and figures. It had to be more of, actually asking people or prompting them to stop smoking. That's kind of a call to action that would be included in there. And that's the kind of thing you got to think about. It's an action that you're hoping that the person who receives that appeal receives. And the action that's being asked of them isn't to donate to the organization. It's more so something that will benefit them, benefit the public sector, and is in line with the mission of the organization. The second kind of component there that you need to keep aware of is audience. So if you're sending out an appeal that is only going to donors or previous donors of the organization, people are going to look at that. We are going to look at that and say, well, that's most likely and primarily focused on fundraising. Where if you're sending out something more broadly to both donors and non-donors and that sort of thing, you've got a broad enough audience there where you're not just trying to raise funds, you're kind of exercising that call to action item that I mentioned. And then the last item is content. And again, you need to have some sort of programming element there if you want to have the opportunity to do that allocation. It can't just be an ask for contributions. Okay. So, this is, Preston mentioned this in his, and I think Courtney did as well. This would be certainly something that when we are performing the audit, we may not be aware of all of the types of appeals and fundraising efforts you all have in place. So this is something that you could potentially be thinking about during the year when you're working with your development people, when you're seeing all that sort of information and thinking to yourself, well, this may be an opportunity to move some of those costs out of fundraising and into programming, but let me speak to my auditor about that first. And we'd be happy to look at those things. Or if you want to just collect them and keep them for when audit time comes around, we could look at them then. But again, it's maybe something we're not aware of, but it may be an opportunity for you all to do, to help your ratios and strengthen them a little bit. All right, and the membership development activities, I touched on this. Again, you can see a couple of examples there as well. We don't see this a great deal. And in most cases for the clients, the typical 501c3s, there's not really much in the way of membership there. So not a lot to add. And then finally, presentation options. I think we're all familiar with these. Most often we see the separate financial statement. I think that is kind of the preferred method to present your functional expense allocations. You can include it in your notes, and we do see that from time to time. It has to be a fairly simple presentation because it can get squeezed in there. Or if you have a really simple approach to it, you can include it on your statement of activities. But I think the most fully transparent way is that separate financial statement. And then, of course, with any note disclosures on how the costs are allocated. So any of the costs that have to be allocated more than, across program and management, general and fundraising, you need to have that note on what that allocation methodology is. And again, it's fairly generic, but it should be as detailed as possible to help users of the financial statements understand where the allocations are. Okay. Real quick before I jump to that, I did want to mention just kind of one item that we don't see a whole lot. I see it every once in a while, but kind of the minimum requirements on the statement of functional expenses are to present your expenses kind of by the natural classification, so salaries, benefits, rent, so forth, and then by the functional categories kind of across the top. We have seen and heard about situations where kind of an alternative presentation is then to turn around and take what those management in general and fundraising costs are. And if you can find a method, kind of a method that would want to, we would certainly want to look at it, but to allocate those kind of as a below the line allocation back across your programs, it's an opportunity to kind of convey to the reader that, hey, yes, we do, spend this much on program. We do have management in general. We do have fundraising. However, without those, we could not effectively run these programs. So if you're interested in learning more about that, I've got some examples I could certainly share with you. But again, we've seen it very rarely, but as long as you meet those minimum requirements, it's kind of an alternative way to convey and tell your story a little bit more around the fact that, yes, we do have, the 80% going to program. We do have this other 20%, but again, it's necessary in order to operate the programs effectively. Just a couple, kind of a couple of comments here on functional allocation methods. I don't plan to kind of go into these in any detail, but did just want to have these in here if people are kind of thinking about, well, how should we or what should we be thinking about? What metrics should we be using to do our allocations? Certainly, head count's a popular one, square footage for rent, and of course, time, which we'll talk more about that in a couple of minutes, but making sure that you have your people tracking their time appropriately and effectively to make sure that you get it all in the proper category. On the Form 990 considerations, I know that we're going to have a little bit more from our tax group here in a couple of minutes, but there were just a couple of things that I thought were important to include in here. Certainly, you're preparing this for both audit and tax. There's a great deal of overlap there. And so there are a couple of differences, from an in-kind standpoint and that sort of thing that may come into play. But for the most part, you want to have your methodology and all that sort of stuff the same on both ends. So make sure that that's the case whenever possible. I wanted to have just a little bit on, the different watchdogs that are out there that are monitoring nonprofits. Always people, when I talk to them about their functional expenses and how those are being allocated, that's a big concern of theirs. And so they are being monitored by, and they are being used to rate your organizations by Charity Navigator specifically. And there's kind of, a couple of different systems in place now. Again, I don't want to get into too much detail on these, but they have the star rating system. That's always been there, kind of 4 stars is the best you can get. And this particular ratio around functional expenses is a component, but it's not, it's not the only thing that you're being rated on. And there's a lot of other things that go on in there. And then they have this new, fairly new Encompass rating system. We have a nice article on our blog if you want to read more about it, written by my colleague, Amy Menifee, but it goes into much more detail than what I have here. But, currently there's a couple of, metrics in order to fall under the star rating system that are hard for non-for-profit, certain not-for-profits to make. For example, you got to have 7 years of 990s in order to be rated under the star rating system, where the Encompass rating system is kind of looking at 3 years. So the overall, and there's also some revenue, differences there too. You got to have $1 million or more in revenue under the star rating system. The Encompass rating system, I think, goes down to 500,000 if I'm not mistaken. So anyhow, you can see in the last line here that it's really going to increase the number of nonprofits or charities that are rated from, roughly 9,000 to 170,000. I even saw where they're thinking it may be as much as 200,000. So a lot more, opportunities for donors to go to Charity Navigator or other sites potentially and learn a little bit more about your nonprofit, determine whether they want to donate. And really kind of the reason and what's allowing this and making this possible is, systems now that can actually look at 990s and kind of do a lot of the number crunching, allows the Charity Navigators of the world to reach a lot more nonprofits because they can just basically use these, AI type, artificial intelligence type computers to crunch the numbers, so to speak. Okay. And with that, we're going to pause for a moment for code word number 5. The code word is 549. And as we've mentioned, it does carry forward to the next slide. So you can see there at the top of your screen, 549 is the code word number 5. All right. So again, just a little bit more on the new Encompass rating system. There's kind of 4 key indicators. You can be rated without, necessarily having information in all 4 of these sectors, or all 4 of these beacons they're calling them, which is kind of interesting. So for example, if you just had you can have just a rating on your finance and accountability beacon, or your impact and results. You cannot be rated solely on leaders and adaptability, or culture and community. So just something to think about there. And this is kind of small, but this kind of digs down into a little bit more detail on the finance and accountability. You can kind of see there at the kind of towards the top under your program expenses that, again, your program, service percentage, or that ratio, is one of many factors that comes into play on these ratings. All right, so that kind of brings me to what are some common pitfalls of functional expense reporting. And these first 2 kind of go together, and most folks really want to make sure that they're loading up the program expense category as much as possible. And we certainly understand that, we get it. But going back to those ratings that I just showed you, and kind of why I want to drill into that a little bit, was you can see that that's not the end all be all when it comes to those rating watchdogs. So just kind of keep that in mind. And I think it's really important to understand how much you're actually spending on program management, general, and fundraising, so that you can, best manage the not-for-profit. Maybe your program percentage isn't quite where it needs to be, and you kind of need to know that, because if you can maybe rework some things internally, you can expand your programming and help more people, or provide more services, whatever your mission is. So just kind of keep that in mind. Other than that, I don't think I want to drill on anything here any further. And just kind of a couple of tips. This first one is really important to us. We like policies. Having a written policy on how you're doing your allocations would be great. It's clear when we're working with our nonprofit clients that their controller, their CFO, whoever's doing the allocations, knows exactly what they're doing. They've got it all in their head. And we would just like to take the opportunity to say, if you could commit that to paper, that would be great, especially when there's turnover and things like that. We're trying to kind of going back to our audit files and, pulling our documentation and sharing it. It's just not the best way to do it. If you could get a policy in place, kind of spell everything out in pretty good detail, have your board or your finance or audit committee review and approve it, so that they kind of understand what the process looks like. That would be, I think, helpful for all parties. Verifying the allocation methodologies annual, that would come into play. If you have a policy, you probably want to review that annually, looking at how you're doing your allocations, and if you've introduced some new programming, or unfortunately maybe you had to do away with the program or moved into new space, so you've got maybe some new square footage that you need to consider. All that sort of thing would be part of that annual review. Training employees diligently, or train employees on diligent timekeeping. That's really important, because again, you want to make sure that you've got most of our nonprofit organization salaries is their most significant expense. So making sure that you've got that going to the proper place, allows you to make the best management decisions possible. Okay. And the only other thing I'll point out here at the end is engage your auditor. This is certainly an area where we can provide our thoughts, our insights, and we don't have to just do it at audit time. So if this is something that, it's almost better to work on it mid-year or something like that, when we're not so focused on just getting the audit completed. We can kind of talk through your methodologies and kind of what we're seeing with some other not-for-profit organizations, and maybe perhaps provide you with some ideas to kind of help you manage this process going forward. Okay. Any questions on this particular piece? If not, I'm going to jump to the split interest agreements. Didn't leave myself as much time as I had hoped. So I'm going to kind of work through this maybe slightly faster, but again, making sure I touch on all the highlights and Feel free to ask questions if I don't go into the detail you thought I would on one slide. We can kind of revisit it at that point. Okay. So before I kind of walk through this, the reason why, again, I think it's important that you all understand why we decided to include this in the presentation. And this is another area where there are situations where we may not necessarily be able to, pick up on a split interest agreement if the client doesn't point it out to us, if it's not recorded as it should be. So one example of that is you could be receiving monthly, annually, whatever the case may be, revenue or checks from a trust that you all are obviously that your organization is obviously a beneficiary of. If we don't select that when we're doing kind of making our sample selections around revenue, we may not become aware of it, or if we just select one and all the documentation isn't there to tell us you've been getting this year after year after year, well, then there's a chance that it may not, rise to the level of, oh, well, maybe we need to dig into this, and this could be a split interest agreement that needs additional accounting around it. So that's kind of the thought. And again, there's 6 main types here, or there's 6 types here. The main ones that we see the most of are certainly the gift annuities, and then lead trust, remainder trust, and then perpetual trust held by third parties. So those are the ones that I got a little bit more detail in the presentation. So again, the other 2 we see very rarely, especially here recently. I haven't seen a whole lot of those, so it didn't feel like it was necessary to go into as much detail on those. Okay, so charitable gift annuities. So this is a situation where you have a donor enters into a gift agreement with you. They give you some assets up front, and you've agreed to make a annual, a quarterly payment to them for some period of time that'll be specified in the agreement. Fairly straightforward from that, code word number 6, sorry. Code word number 6 is 620. And again, it'll carry forward onto this next slide. So, kind of getting back to charitable gift annuities, you've gotten some assets. You record those at fair value. Oftentimes they're just, investment securities. Maybe it's just a check of some type. You record that. There is not a requirement to kind of account for those assets separately. So, a lot of times we see them kind of commingled with other investments of the nonprofit. There is a liability associated with it, which I just now mentioned, was kind of those annual, quarterly type payments that you have to make out to the beneficiary or to the designee or to the beneficiary. So you need to record that liability at present value. And then there should certainly be a difference there, and that's going to be recorded as revenue without donor restrictions. When you're recording that liability, the key numbers, most of the numbers are right there in the gift agreement. There's certainly a couple of other factors, one being the 75/20 rate, which is an IRS published rate specific to gift annuities, trust, and that sort of thing. So you'll want to make sure you grab that, as well as, a life, if it's for the life of the donor, a life expectancy table, something like that. It may just be for a specific term. So you'll have to know the details there. And subsequent recordings, fairly straightforward. Any payments made, you reduce that annual or the annuity liability, and then you got to adjust that liability each year back to what it should be. The only thing I want to also point out here is from time to time, and we've seen it, more recently, I feel like sometimes these gift annuities will go underwater, meaning that the assets that were received on the front end, the individual, if it's based on their life expectancy, they've outlived those assets. So then you're carrying a liability and you no longer have any sort of asset associated with it. Unfortunately, the nonprofits entered into the agreement, so there's not a lot of options. We have had a couple that have shared that they went and spoke to the donors and were able to then kind of rework the agreement. So you may want to go that route, but that's just kind of a point of caution that we see from time to time. All right, so that brings us to charitable lead trust. Here you have the definition of a lead trust. And so essentially a lead trust is a situation where, a donor sets up a trust, they put their assets in the trust. That trust is set up to make payments to your not-for-profit organization for a term, a period of years. And then at the end of the lead trust, any assets remaining will go back to the donor or to the donor's beneficiaries, whatever they've designated in the trust agreement. Okay. There's 2 types. One is where there's a fixed dollar amount that you're receiving annually, or there can be one where you receive a percentage of the trust fair value, whatever that is, most likely on an annual basis. All that'll be described in the trust documents. If the not-for-profit is the trustee, so we have some examples where you are the trustee, some where you're not. If you are the trustee, well, that means that the assets that funded the trust are held by the not-for-profit organization. The not-for-profit is the trustee. You've got to record those assets at their fair value. Then a liability in this case is actually for the amount that's going to go back at some point down the road to the beneficiary or its designees. And then again, any difference there is recorded as revenue with donor restrictions in this case. Subsequent reporting or recording the not-for-profit is the trustee. Investment earnings should be reflected, as a trust asset and in the liability accounts. And those distributions that the nonprofit is receiving, they're moving them out of the trust and into their operating account or their typical investment account on at least an annual basis. That's really just a reclass between donor restrictions or with donor restrictions to without donor restrictions. Okay. So the situation where the not-for-profit is not the trustee, so the donor has elected to use either a banking institution or a trust company. They set the trust up there. You all, assuming that you are notified that you are a party to this trust, you would record a beneficial interest in the trust. So the trustee in this case is going to be, or typically will be, very open and provide statements and that sort of thing to you. So you'll record your beneficial interest. And then the revenue is with donor restrictions is recorded. And that's, initial recording. And then subsequent reporting, the change in the beneficial interest in the assets would be recorded. Any distributions, again, you can see that they would be reclasses from with donor restrictions to without donor restrictions. And again, if any present value techniques are used, because in this situation, you're calculating your beneficial interest as those payments to be received on the front end of the, kind of on the lead trust, then all those assumptions would need to be updated, annually. And now we have code word number 7157. All right, so charitable remainder trust. This is kind of the situation where, again, a donor has set up a trust. You all, your not-for-profit is going to receive whatever the remaining interest in the trust is after payments are made on the front end to a designated beneficiary. Again, two types. They can be fixed dollar amount or a fixed percentage of the trust fair value. And again, initial recording, if the not-for-profit is the trustee, they receive those assets on the front end, so they need to record those at fair value. And they also need to record the liability for those payments that they're going to have to make to the beneficiary. And again, if there's a difference, and there will be or should be, it's recorded as revenue with donor restrictions. Subsequent reporting, kind of the same deal. Any investment earnings and distributions paid should be reflected in the not-for-profit statement of financial position. The liability, each time you make the payment to the beneficiary, is going to be adjusted through that liability account. And each year you need to revisit the liability to make sure it's still, the appropriate amount as of year end. So you kind of got to go through that process again to make sure that any discounts or any other sort of changes in actuarial assumptions are reflected to the liability, and it flows through the not-for-profit statement of activities. If you're not the trustee, you've got that beneficial interest again, and this time you're just recording the remainder interest. And again, you're recording it as, revenue with donor restrictions. Subsequent reporting, you're going to update that fair value of the beneficial interest. So again, you're going to get a statement from the trustee, at least annually. Hopefully that's not an issue. And then you use that to adjust that fair value amount. And again, any present value techniques need to be updated as kind of part of that process. This is the piece where I said, we don't see these a whole lot, but I thought I'd at least include the definition in here. In the interest of time, I'm going to kind of move through it, but if you all have specific questions or want to talk about this, or you're seeing these, let me know. I'd be happy to kind of have those conversations offline. And we're quickly to code word number 807. All right, and this is the last kind of trust that I wanted to talk about in any real detail. This is a situation where you have a perpetual trust held by a third party. So you've got a donor who has set up a trust. It's a perpetual trust, so it does not have an end date. It's basically into perpetuity, and you are the beneficiary of that trust. So basically, this is very similar to an endowment where you don't hold the assets for the endowment. They're held by a third party, but because it's into perpetuity, you can kind of treat it, or you treat it similar to an endowment. Here, distributions, they may or may not be restricted by the donor. So that's all going to be held, subject to whatever the trust agreements and the trust documents say. So you'll absolutely want to get a copy of those and maintain those for your records. And we will certainly would always want to see a copy of those. You can see that often established with, the bank serving as the trustee. And, just kind of say, well, why wouldn't they just give the not-for-profit the assets directly? Well, maybe they, the not-for-profit may not have a sophisticated investment, vehicle, or maybe interested in investing assets. So you can certainly get the same result by using, a third-party trustee in this situation. Really quickly on initial recording, again, assets are recorded at fair value, beneficial interest again in a perpetual trust, and then with donor restrictions recorded for the same amount, effectively establishing an endowment. So that's where I said it's similar to accounting for an endowment. You need to revalue the assets each year to fair value, and any change is recorded as a gain or loss in your statement of activities. Okay. And of course, you're getting distributions hopefully annually. And so the investment income would be recorded as either with donor restrictions or without donor restrictions, depending on, again, what the trust documents require. Life interest in real estate. Again, this is the second one that I said we don't see a lot of every once in a while. And again, not going to get into the details here, but if you have questions, would like to talk about this. And certainly if you have one of these or talking to donors about one of these, go ahead and reach out to us, to your audit team, and we can kind of talk about the recording and subsequent reporting around that. All right, so as I mentioned, there are situations where these become kind of tough for us to necessarily identify. Certainly, hopefully the accounting department at the not-for-profit is monitoring them pretty closely, but a donor may or may not make you aware that they've set up a split interest agreement. We have seen situations where the not-for-profit didn't even know that this was out there, especially if they had a remainder interest in a remainder trust. So again, most likely the development team or the advancement team knows that they exist and that you all are a party to it. So making sure those communications between accounting and development is really, really important. I think that's the only thing to point out here. And just very briefly, some tips for reviewing and recording split interest agreements. We talked about the accounting. Obviously, read the agreements very carefully. All the key information should be included in there. If it's not, certainly talk to the donor if you have the opportunity, or the trustee. When possible, make sure that both parties are in the same page in terms of how this agreement and how this vehicle should be reflected on the not-for-profit's books. Share the agreement with us, your auditors, or whoever your auditors are. And don't necessarily hold it till the audit. That's one of those things that would be great to hear, and we can kind of do a lot of the legwork prior to the audit beginning. So, once it's in place and, it's going to be something that we're going to need to look at as part of the audit, go ahead and share it with us. We can have that conversation in advance. Again, trying to make the audit process a little less burdensome for you. And then just very briefly on calculating, you may have picked up on this, but you want to, once you calculate the asset, you do that first, then you do the liability, and then you're going to have a net difference, which should always be a contribution. If not, you need to have a conversation with your development team, but record that net amount as a contribution. Okay. All right. So any questions from anybody at this point? Okay. Well, with that, I'm going to turn it over to Ginny, Belcher, and Jayme, Mika.
Thanks. Okay, I'm Ginny Belcher, and with me is Jayme Mika, and we're going to take a look at the 990 and the 990 PF today, and some of the areas that we have common questions and things we ask for and the clients ask us about. We thought we'd kind of go through and maybe give a little bit of a more detailed explanation. So our starting point for preparing these returns is the audited financial statements, or in the case of an organization that doesn't have audited financial statements, we'll use their financial information. But inevitably, when we start preparing these, we come up with a list of questions, a list of things we still need that we can't get from the audit information. And the clients also ask us questions like, well, why do you need this? You know, what does this mean? So we're going to highlight a few of those. I've not got the whole 990. It's not up there every page, but just the pages that we're going to talk about. So if you want to slide it up.
Control and escape right here.
No, it's not working.
Yeah, let's see.
It's okay.
There it goes.
What'll happen is yes, so then control escape. Click yes.
Okay,
And then,
there it goes.
so
Okay.
here it comes.
Okay. So the first question we get a lot from our clients is, what's the difference between the principal officer at the top of the return and the officer that's signing the return? The principal officer is actually the officer, regardless of his title, who is designated or in charge of implementing the board decisions. They actually run and supervise and maintain the not-for-profit. The signing officer doesn't necessarily have to be the same person. The signing officers, any officer, either the president, treasurer, vice president, assistant treasurer, or any other corporate officer who, as of the date the return is filed, has the authority to sign it. And so we thought we'd put this in there because this question comes up a lot. Okay, the next page.
This can't.
It was.
I gotcha.
Why is it not scrolling?
It's okay. Just a little bit of, so you have to have the mouse over here. There you go. And make sure that the mouse is on this screen. It's different from this one.
I can't even see the mouse on that screen.
Here, we'll put it right here. You can still go.
Okay.
So it's in the corner right there.
Okay. Sorry about that. Little technical difficulty. Okay, go to page 2.
Okay, I wonder if I could.
It's not moving.
Okay, the mouse is over to the right.
Gonna put a little bit of pressure on there for me. Okay, when you're scrolling,
Okay.
it's a little bit.
Part 3 is the statement of program services, and we get a lot of questions about this, but we also ask for this information. One of the things we want is to know if the narrative needs to be updated every year. And you would not believe the number of clients that say, oh no, it's the same as last year. Well, if you've got donors or people that are interested in looking at your not-for-profit and contributing to it, this is one of the sections they're going to go to, and they're going to read, you know, the programs, what you're doing and everything. So if you've got any kind of new initiatives or things that you've stopped doing during this tax year, then you want to update this. You also want to update it with any numerical data that you have on that program. So it's very important, and don't just say, oh yeah, it's what we do. We do the same thing every year. So I thought I'd just point that out. No, let go. We had to embed this so you can see it. That's why we can't click, and it's just.
Next page.
Yeah.
Highlighted one.
It's down bottom.
Okay.
Another thing we ask for is the number of W-2s and the number of 1099s. And can't get this from the audited information, but the reason we ask for this is because it has to be reported on the 990. But the IRS is looking at this, and they're going to actually match the information that's on the 990 with the actual form, the W-3 or the 1096 that was submitted to the IRS to make sure that it's cohesive and agrees. And then we can go on to the next one. Keep going down. Okay, so then on part 6, we have section B, the policies. And a lot of times some of these aren't put in place by the organization, or they put them in place the next year. And so we go through this with the clients and we ask them, did any of this change? And say, yes, we put a conflict of interest policy in place, or we started a compensation policy where we look at it to determine compensation. And many of these questions require an explanation or description. So when we ask and they say yes, and we say, please describe, we need a description of how do you monitor your conflict of interest policy? How do you determine the compensation? So we wanted to point that out to let you know that it's very important and the IRS requests that information. Okay, go to the next one. The next page is the list of officers and directors, and everybody's familiar with this. And I do want to point out that this section is not just the officers and directors that are listed at the end of the year that you're filing. It's any officer or director that was on the board at any time during the year. So if you have a change out during the year or people have resigned, whatever, they need to be included, as well as the current officers and directors. Again, we need the W-2 information if they're paid via wages, or 1099 information for all of them, again, for that matching piece with the IRS. But we also ask for, and don't always get, but need it, is any other compensation that's paid. It can be an estimate or the actual amount by the organization on their behalf. And these are things like contributing to a 401k, the employer portion, if you pay the health insurance premiums for your officers, directors, key employees, anything, then they're not out of pocket. They need to be listed there as well. We don't always get that information, but it's important, and we want to point it out. Additionally, there's a new thing with this too, that now a lot of clients ask us, can we put the compensation, the people that are compensated, at the end of the list? And we used to be able to do that, but unfortunately now the IRS says that the compensated individuals have to be listed on the 990 from highest to lowest, and they have to be the top listed in the beginning. So we can't really bury that information, which I know sometimes we want to do it on the second page of the list of officers and directors. And I just wanted to briefly mention about independent contractors. We need to list the 5 highest independent contractors that you pay more than $100,000. And when we ask for this information, inevitably we'll get a list of like 20 independent, they think are independent contractors, but actually they're just vendors. Independent contractors are law firms, professional fundraising firms, if you pay architectural firms, investment management companies, or any other kind of management companies. It's not Dominion Power, it's not, the health insurance company. But if you're unsure, you can always send us everything, and then we'll pull out the ones that need be. And then go to the next page. I want to mention a few things that come up on the statement of revenue, and especially around the contributions. On the audited financial statements, there's a line item that says contributions. But for our purposes, we need to break this out a little bit differently. First is contributions from federated campaigns. So if you get contribution indirectly from the public through one of these federated campaigns, it would be like a contribution from the United Way. Those types of contributions, which are not given directly by someone to the organization, need to be listed on line 1A. Second type of contribution are the portion of the fundraising event income that you raise that we have to pull out and put up here. So if you've got a fundraising, a dinner that you're charging $300 a ticket, and the cost of the dinner to the individual is $200, we're going to put the $200 of fundraising revenue down in the section on fundraising events, but we're going to put that $100 over and above the cost of the dinner up on fundraising events in column C. So we need that broken out as well. A lot of times that's kind of unclear and we're unsure when we get the information. And the third area is non-cash contributions. Non-cash contributions, and Courtney touched on it with her in-kind earlier, are actual contributions, real estate, any other kind of tangible assets. There are also stock contributions. What it doesn't include are the in-kind services and use of facilities. While they're reported on the financial statements, they're not reported on the 990. So, and I will state too, when you get a stock contribution from an organization, a lot of times they'll say to the organization, they'll say, oh, well, we sold it immediately. Doesn't matter. You still got a non-cash contribution of stock, even though you liquidated it right away. So we'll need that information broken out to fill out the statement of revenue, the contribution piece of the 990. Next page. And I just wanted to briefly touch on the statement of functional expenses. Richard talked about this a lot. Generally, if it's an audited financial statement, it's usually broken out most of the time for us, very neat and tidy. There are a couple of things we don't have, which is the compensation for the officers, directors, and key employees. That's usually embedded in one line item on salaries and wages on the financial statement. So we will need to request that this information be pulled out and separated into the three buckets: program service, management in general, and fundraising. And additionally, at the bottom on column B, the total program service revenue, or excuse me, total program service expenses that we have on the statement of functional expenses needs to tie back to the narrative section on the statement of program services that we discussed earlier, when it's broken out into the different program services. And we'll ask that question as well. And a lot of times we'll get a breakout and it doesn't tie back. So just keep in mind that whatever your number is on the bottom of column B on this statement needs to tie to part 3, statement of program service narratives. That's it for the actual core form, but I do have some comments on some of the schedules and some things to note when you're providing this information to us. The Schedule A is the public support test. And there are 2 tests. The first test is for organizations that get contributions from the general public and from governmental units. And the second test is for organizations that have more than 33 to 30% of their revenue is from contributions, program service revenue, admissions, that kind of thing, and no more than 33 1/3 of their revenue is from investments, income. I'm not going to go into a lot of detail on the 2 tests, just the fact that when we are calculating the public support percentage, there are certain contributions and certain revenue that we have to pull out in the calculation. And the test under 170 B1A5, 4 and 5 pulls out contributions from any individual other than a publicly supported organization or government unit that exceeds 2% of your total contributions for a 5-year period. So that excess is pulled out in the calculation. So when we ask for total contributions for a 5-year period for all the individuals, we need that information for this calculation. On the second page, the next one. For the second test, it looks not just at contribution income, it looks at your admissions, your program service revenue, and any other revenue that's not UBIT. And in this test, we're going to ask for the information for the 5-year period. We're going to pull out any contributions from disqualified persons, which are board members, substantial contributors, family members of board members, that kind of thing. So we're going to pull that out for the test, as well as any contributions, any revenue they received from admissions, receipts, or any other activities that are disqualified persons. It's a mouthful. So we're looking at everything, but in certain buckets. And like I said, I'm not going into the detail of the computation, just that when we ask for this information, this is why we need it. Next one. On Schedule B, this is where we list the contributions, depending on your type of organization, whether it's anything greater than 5,000 or anything 2%, greater than 2% of your total contributions, depending on your organization. Any event, we need name, address, and dollar amount. If it's a stock contribution, we need the name of the stock and the number of shares. This information is not published on GuideStar, but the IRS requested for the form that the tax return that you're sending in. And I would note that when there's stock contributions, when they're pledge payments, they're not, the pledge itself is listed on Schedule B when it's accrued on the financial statements. And then if you have a pledge that's going to be paid over a 5-year period, the actual pledge payment is not included on Schedule B in the year that the pledge payment is made. It's included on Schedule B in the year that it's accrued. So that's sometimes can be a little confusing. Go to next. Keep going. Keep going. Yeah, keep going. Keep going. Okay, I just want to briefly mention, go to the next page. On Schedule D, there are a couple of, can you go up to the next page? Yeah.
Like that?
Or keep going up. Yeah, I'm sorry, no, up to, no, the other way.
Next, sorry about that.
Right here, okay. So on Schedule D, we have a reconciliation section, which is reconciling between the audited financial statements and the tax return. And a couple of items that are sometimes confusing is the net unrealized gains and losses and the donated services and use of facilities. Unrealized gains and losses are included in this, in your revenue statement on the audited financial statements. It's part of revenue. For the tax return, it's not included on the statement of revenue, but it's a reconciling item over here. Same with the in-kind contributions. They're not included on the statement of revenue on the 990, but in order to reconcile back to our number, we have to include those donated services and the use of facilities here. Just want to bring that up, okay. Okay, Schedule G. Schedule G is required if you have gross fundraising revenue of 15,000 or more. And it's reported on the statement of revenue, but we also need more details on Schedule G. So if you do have a lot of fundraising events, we're going to need to provide us with each event, the gross revenue, and then any of the expenses. You can move down to the second page on this one. And I can show them right here. The gross receipts, as well as the actual direct expenses for each fundraising group. Now, the IRS requires that the top 2 events be listed. And then if you've got 3 or 4 more others, you can just add them all together and put them in the third column and add the number of events that there were. But a lot of times we'll get, oh, there's 10,000 of fundraising expenses, but we really need it broken out into the type of expenses. And again, we start with the gross receipts, but we pull out the piece that is the contribution portion to get back to the gross income from the actual event. And all of this should tie back to your statement of revenue as well. And the last schedule that I wanted to focus on was Schedule M, and this is the non-cash contributions. And this is, if we've got multiple contributions or types of contributions, we need to break them out here. We have the total on the statement of revenue, but here it'll categorize what they actually were. And not only do we need the value, we also need how we determine the value of that non-cash contribution, which now, according to Preston, we might have that information. So we would have to ask on the new thing. And we also need to know the number of donors or the number of contributions. And a lot of times we're not provided with that. Those are some of the key things that we find that we're asking for year after year when we're preparing the 990s. So I hope that this might be helpful when you're pulling the data together for the preparation of the 990 and the 990 PF. And I'm going to turn it over to Jayme, who's going to touch base on a couple of items on the 990 PF.
Okay, I don't know if the 990 PF is relevant to anybody online here, but just going to touch on a couple of the more complicated sections. So can you scroll up one more?
Mm-hmm.
The 990 PF is down. I'm so sorry. Yeah, just right here. That's good. It differs so much from the 990 that people get very confused about what goes in what column on page 1 and how to actually read this form. So column A is basically your books. So if you've audited books, your numbers in that column are going to tie to your audited financial statements, less maybe unrealized gain losses and that kind of stuff. But column B is just for your net investment income. If you have securities, interest that are kicking off, interest, dividends, capital gains, that is all listed in column B, and your excise tax rate, which is now a flat 1.39%, is based on the net income at the bottom of column B. And then column C is reserved for operating private foundations. And then D is your charitable purposes calculation, which the grants that you may have accrued on an accrual basis in column A, in D, it is cash basis. And that cash basis number is used in the calculation of the required payouts later. Can you scroll? Yes. So just pointing out that the contributions are different in each one of the columns. The 990 PF now is required to be e-filed. So there are certain items that have to be presented. The capital gain details, in the past, we've done attachments and, you know, you paper file it and away you go. Now it has to be on here. E-filing can be very tricky, and you need all of the information that is requested in order for it to go to the IRS. And if we get it in an Excel form, makes life a lot easier. But that's pretty much it for capital gains. The IRS has repealed the 5-year rolling calculation to chase the 1% tax bracket like we've done in the past. It's now a flat 1.39, so this is obsolete. That's the flat, that is the tax, keep going.
No, no problem, it's okay.
I get some questions about Form 4720, which is the additional tax paid on self-dealing, excessive compensation, if you pay compensation to your executive director or your board members. This section, you can answer yes to the upper questions, but there's also an exemption, especially when you pay your executive director. And the exemptions are you cannot overpay them. It has to be reasonable and necessary in order to get the foundation's purpose achieved, I guess. Keep going, go on to the next one. That's fine. This is calculation for what your required payout would be for the IRS. It is based on the average fair market value of your securities, cash, any assets that you hold. You have to do, we usually ask for the monthly statements so that we can get a beginning and ending fair market value per month, and then average it together for the year. And then 5% of that balance is your starting point for your 5% required payout for private foundations. And then your distributable amount that you're allowed to factor in the taxes that you've paid on for excise tax to reduce that required payout. Okay, this is probably the most confusing schedule ever. So I'm just gonna real quick. It is used to calculate your amount that you have to pay out, but it starts with your 5% of the fair market value, and then you get an adjustment of the grants that you paid in the current year, less any carryover from the prior year, to arrive at the amount that you have to pay out before the end of the successive year. So this would be calculating what you'd have to pay out for 2021.
Okay.
Grants and contributions, again, because of the e-filing, this information is vital to submit to the IRS. A lot of times we get a list of the grants, but we don't get a purpose. And we can input general purpose, but a lot of these charitable organizations, public charities, they give you a very specific purpose for the grants. So listing that and listing the good that you've done by contributing this money to them is a good practice. And that's it. That is it. That is the end of the private foundation. Richard, are you going to wrap up? I can. Sure.
All right, well, that concludes our presentation today. As I mentioned, we got a few questions throughout, but you all could still have some. We'd love to answer those. For folks that are here, we'll be hanging out. We can answer those today. Or for those online, if you didn't get a chance to ask your questions, please reach out to anybody that spoke today, and we'd be happy to spend some time with you and answer your questions. Thanks very much for attending, and thanks for everyone. Thanks to everyone who spoke and did some presentations. And with that, we'll come to a close.
Awesome.